So we all dream about building wealth, right? But have you ever stopped to think about what happens after you start to succeed? Turns out the road to riches is actually filled with these hidden traps, dangers that pretty much only show up once your net worth starts to grow. Let's dig into what they are.
And that's a really important question to ask yourself. You'd think more money automatically means more security, but a lot of the time it just brings more complexity and totally new kinds of risk. Think of this as your guide to navigating that tricky terrain without falling into the pitfalls.
So here's what we're going to break down. We'll look at 4 key areas. First, the mistakes you can make with your investments. Second, how your own spending habits can sneakily undermine all your success. Third, the long-term threats that just creep up on you. And finally, the one trap that has nothing to do with money at all.
All right, let's dive right in with Section 1, traps in your portfolio. As your pile of investments gets bigger, so does the temptation to make some classic and very costly mistakes. And ironically, this is the place where your own confidence can become your worst enemy. The first trap is a big one, putting way too many eggs in one basket. It's called overconcentration. You know, the rule of thumb is, if any single stock is more than 10% of your portfolio, you're not really investing anymore. You're basically betting a huge chunk of your financial future on how one single company performs. That is a seriously high-stakes gamble.
And this slide right here, this is a serious cautionary tale. Imagine you bet big on Intel way back in the dot-com bubble. You would still be waiting to break even today. Now, compare that to a simple, diversified investment in the broader market, the S&P 500. That would have grown your money 5 times over. It's just a stark reminder of why diversification isn't just a buzzword.
And that leads us right into the next trap, overconfidence. You know how it goes. You pick a couple of stocks, they do incredibly well, and suddenly you start feeling like an investing genius, right? But here's the hard truth. A 2 or 3 year hot streak might not be skill. It could very well just be you getting lucky in a market where everything's going up.
And that overconfidence can be so dangerous. If you're ever tempted to turn that supposed skill into a day trading career, this number should stop you in your tracks. A staggering 95% of day traders lose money in the long run. The minute your confidence turns into bravado, you start taking bigger and bigger risks, and that is a fast track to financial disaster.
And finally, as your wealth grows, so does the complexity. Suddenly, you've got multiple accounts, maybe some angel investments, real estate. It all gets so complicated. And this quote here reveals a pretty telling secret. Even people earning 6 figures often just nod along, pretending to understand what they're getting into. This creates these massive financial blind spots, where hidden fees and risks you don't even see can just drain your wealth away.
Okay, let's shift gears and talk about our second section. See, it's not just about how you invest your money, it's about how you spend it. These are the traps that cause your wealth to just vanish, a lot of times without you even noticing it's happening.
This is maybe the most common trap of all, lifestyle creep. As your income goes up, your expenses just magically rise to meet it. I mean, look at this cable. It's not a huge surprise that 57% of people earning under $50,000 a year live paycheck to paycheck. But here's the jaw dropper. A full 40% of people earning $500,000 a year say the exact same thing. This just proves nobody is immune.
So what's the antidote? It's a classic lesson from the famous book, The Millionaire Next Door. The real secret to building lasting wealth is to let your income grow while you keep your lifestyle relatively modest. Instead of piling up more things, focus on collecting experiences, travel, learning new skills, spending time with people you love. Those are the things that create lasting memories and personal growth that no object can ever match.
All right, the next spending trap is being tax inefficient. For most of us, taxes are our single biggest expense, way more than our mortgage or car payment. And yet, so many people leave money on the table. For instance, tax loss harvesting sounds super complex, right? But all it really means is selling an investment that's down to cancel out the taxes you owe on an investment that's up. Another classic mistake is holding stocks that pay out cash dividends in a normal brokerage account, where you get taxed on that money every year, instead of in a tax-sheltered account like a 401k or IRA.
And speaking of inefficiency, don't be lazy about your debt. If you have a mortgage, just a 1% drop in interest rates could literally save you hundreds of dollars every single month. The key question is simply, how long do I plan to stay in this house? As long as your monthly savings will cover the refinancing fees before you plan to move, it's pretty much a no-brainer. All right, let's move on to the really sneaky stuff, the silent wealth killers. These are the traps that don't hit you all at once. They're these quiet, long-term threats that you might be totally ignoring right now, but they can do some serious damage down the road.
First up is the trap of being asset-rich but cash-poor. Just look at this chart. For your typical barely millionaire, someone with a net worth between 1 and 2 million, a whopping 2/3 of their wealth is tied up in their house and their retirement accounts. They're millionaires on paper, sure, but if a great investment opportunity pops up or an emergency strikes, they have very little actual cash on hand to do anything about it.
Now, this next idea, honestly, it might be the most powerful concept in all of finance. This chart shows what happens if you save just $1,000 a year. The person who starts at 25 ends up with double the money of the person who starts just 10 years later at 35. That is the mind-blowing power of compound interest, and it shows why delaying your retirement savings is one of the most expensive mistakes you can ever make.
But hey, if you feel like you're playing catch-up, don't panic. There's an incredibly simple rule you can use called the half-raise rule. It's easy. Every single time you get a raise, you commit to saving at least half of that new money. So if you get a $10,000 raise, $5,000 of it goes straight into your savings and retirement. It's a painless way to really supercharge your future.
And the final silent killer? Being underinsured. Think about it. As your net worth grows, you simply have more to lose. Your home is worth more, you have more assets, you become a bigger target for things like lawsuits. You absolutely need to revisit your insurance coverage every single year to make sure you're protected. One great tip I heard is to do it on Valentine's Day, because what's more romantic than protecting the people and things you love?
And that brings us to our final section. And honestly, this one's the most important trap of all. It's not about money. It's about the one asset you are constantly spending and can never, ever earn back: your time.
You know, when palliative care nurses ask people on their deathbeds about their biggest regrets, this was one of the most common answers they heard. It wasn't that they didn't make enough money or that they didn't get that one big promotion. It was that they worked too much and they missed out on their lives.
So let's put this in perspective. As your wealth grows, your time becomes exponentially more valuable than your labor. A $5 million portfolio with a pretty conservative 5% return is making you over $684 a day while you sleep. So you have to ask yourself, is grinding out one more hour at the office really worth more than that?
So here's the bottom line. You need to start auditing your time just as carefully as you audit your finances. Yes, work hard to build your foundation, absolutely. But be conscious of that trade-off. Your capital is working for you, which should free you up to spend your most precious non-renewable asset, your time, on what really, truly matters.
So there's your map, a map of the financial traps that are waiting for you on the road to building wealth. The question now isn't just knowing where they are, it's deciding what you're going to do about it. So, which one of these traps will you start dismantling first?